Good evening, everyone. Not late. It's 9 o'clock on the dot. Not late. This isn't Tanner's channel. As long as it still says 9, we are not late. Thank you, everybody, for being here. Kris will be here in a few moments. Please take a minute to read the disclaimer. Kris and I are not investment professionals or registered investors, registered advisors, or anything of that sort. We are just two individuals that do probably too much research, and this is for your entertainment. Now, I have to make a confession. I may have to resign from the cookie game. This is really embarrassing because several people have been telling me to try Walker's butter cookies. I thought I did not know about this. I really thought I did not know about this. I did not order this. This has been sitting in the other room, and the other box that I have is actually just about empty. And I guess I do know about Walker's butter cookies. They're freaking delicious. So I don't even know what to say anymore. I've been eating cookies that I didn't recognize the name of, but they're delicious. I don't even know what to say anymore. I don't know what to say anymore, but they are freaking delicious. They get a solid B. We're going to go B. Solid B. They're delicious. So for those of you that have been recommending it, I truly apologize that I just didn't associate it. I don't know. What a crazy day we had in the market today, man. And this is why I always say time in the market over timing the market. People were freaking out last week. Sky's falling. And you know what? Over the weekend, when you can't make any moves, start to get some breakthroughs. And then the NASDAQ goes up 2.3% today on the heels of a vote. And it's the best single day performance since May. Get the S&P up 1.5%. Dow up almost 1%. I am sure that if you're in Nvidia or SoFi, Meta, any of those companies, you're feeling pretty good right now. So this is why I don't try to time the market at all. And here he is, Mr. Kris. Whoa. What is going on here? And just like that, he left. He's back again. And you feeling all right, Kris? You're on mute. Or you're on the wrong mic. Man, this guy must have like 4 different mics hooked up to that computer. Not yet. Can't hear you.
My bad.
There you go. So
yeah, I just had dinner with one of our followers. That's
nice.
Yeah.
All right. So 1, you're not wearing a hat. And 2, you look like you lost a ton of weight.
Damn it. Hold on. Give me 1 second, Steve.
Yep.
There you go. Now I can hear you. Okay.
Right. So 1, you're not wearing a hat, which is unlike you. And 2, you look like you lost a ton of weight.
I've started to lose weight. I don't know if I've lost a ton of it.
You can tell. You're looking good. Looking healthy.
Oh, appreciate it. I'll take it. Yeah.
I'm next. I gotta get off the cookie game. It's too hard though.
The milk and cookies, bro. Just lower the milk and cookies and you should be good.
I don't know if you heard my opening, but some of the people have been recommending this company, Walker's butter cookies. And I told everybody I didn't have them, right? And it just wasn't clicking. I have freaking 2 boxes. I'm almost done with one. I got another unopened one right here.
Oh, dude, those are bad. Those are super bad.
I may have to retire from the cookie game because I've been eating cookies and I didn't even realize what they were.
those are like nothing but butter, bro.
Oh, they're
The
so
ones
good.
they are really good, but those are bad for you, man. I mean, they're good once in a while, but they're shortbread cookies, right?
Oh yeah.
Yeah. Yeah.
Oh yeah. All
All
right.
right.
We
Yeah.
had a big day today.
So I'll apologize first to everyone. I'm sorry, guys. I was a little late. I had dinner with one of our followers. It ran just a little bit later than I thought it would. So me and the wife, we just rushed home to get it. And so my hat's right there, but whatever. I'll just
Leave it off. You should don't wear hats anymore.
you know what it is? I get out of bed and sometimes I go right to the stream. So like one, I'm
Yeah.
groggy, but more important, I'm like, I don't want to fix my hair. Let me just put the hat on. Or sometimes I don't even shave, right? So today I shaved, so looking a little bit younger.
Okay.
That's probably what's helping.
All right. Well, we're going to break down a company, and this is your company. So why don't you introduce it and get me excited about it so I can go buy some?
Okay. So first and foremost, this is not a recommendation to buy, but it is a good idea to understand why a company is down and then why it has the potential to meaningfully recover. And it doesn't mean that it's going to recover fully back to its all-time highs again. But once again, it's just if we can understand why companies fall, we can understand why companies can get back up. It's that mean reversion of companies getting back to some level of normalcy that provides value for people, right? So the company we're going to talk about today is called Fiserv. While Fiserv is not necessarily something that everyone is familiar with, it is one of the most important technology companies in the banking / POS market in the world. They process more transactions than PayPal does. So I think the last time I checked, the transaction volume that they have is in like the hundreds of billions of transactions per year. And so if you have ever worked at a bank, you've probably, especially a local and regional community bank, you've probably dealt with Fiserv. Fiserv, unfortunately, they've run into some tragedies over the last probably like month and a half to actually, let's just say 6 months, because their downfall really started 6 months ago. And I think they're finally getting to a point where the valuation has become way too attractive to ignore. Now, this does not mean that it can't fall further, but the opportunity here is in a reversal eventually. Okay, so let me give you guys an example, show you guys exactly what this company is like right now. So the first thing I'm going to do is just show you its current numbers, then explain to you guys what happened to the company, and eventually we can go into why this could be a great recovery play. So the first thing is this company is a very strong company in its total revenues, right? One of the things that happened is prior to 2019, they were known as just Fiserv. They had relationships with a lot of banks. They merged with a company called First Data. That First Data merger caused this giant upward move in revenues. Now, one of the challenges is that when they merged with First Data, they took on a good bit of debt. So let's just plop in some debt right here. Where's the debt in the balance sheet? So even though the business in terms of just revenues was doing really, really well, they had to take on a lot of debt in order to have this to complete this merger. So you can see here prior to merger, they had about $4.8 billion in debt, in which case then they loaded up on debt and they ended up with about $22 billion in debt. Now, the thing is, debt is not a bad thing. I know a lot of people, when they look at debt, they always just go, hey, company's got a lot of debt, we should not be in it. And the thing that I have to remind people is a lot of companies, what they do is they leverage debt in order to acquire other companies in order to grow the business, right? So if you look at a lot of companies that have acquired other businesses using debt, And then over time, they use the income generated from that purchase to pay down that debt. It's created value for shareholders long term. Well, Fiserv, by merging with First Data, they took on a lot of debt, and you can see here they were slowly paying that debt off, right? So once they increased their revenues and their EBITDA, so you can see here their operating profit. Their operating profit grew alongside First Data. So as that operating profit grows, you take some of that profit, you pay some of it back to debt holders, and you slowly delever. So a lot of times what happens is companies, when they purchase someone, especially someone really, really big, they end up taking on a lot of leverage. And the challenge is if they take on too much leverage, it could be a really bad deal for existing shareholders. In my opinion, Fiserv did not do a bad job with this transaction. They actually did a really good move, because you can see here where their their debt was not as high, their growth was kind of flattened out, right? So if you look at the growth here, the growth was 3.6%. So yes, they didn't have a lot of debt on the balance sheets, but they didn't have a lot of growth either. With the merger from First Data, their growth rate started to just go higher and higher. So you can see here from a revenue growth perspective, their revenue growth, their revenue growth, this because this is a year on year. So you can see this spike here is when the merger happened, but their growth went from about 4.8 to 2.5 all the way to like 4.9 to like almost 10%. And it's kind of been on the downward move, because I mean, the thing is, with the law of big numbers always applies to companies, right? So it's really hard to do consistent 10 to 12% growth, especially for a company that's this size. So right now, if you look at its total revenues are about $21 billion. So prior to the merger, the revenue was around $6 billion. Now it's gone all the way to $21 billion. So this right here is a nice growing business. It's not growing like crazy, but it's not slow either. And so this growth is good for shareholders. And the thing is, the more you grow, and as your margins start to improve because you're paying down debt, you're paying down interest from that debt, it's value to you as a shareholder, because that profit goes into your pockets. So that's basically been the case for Fiserv. So Fiserv, for a lot of value investors, they're getting a company that's growing at a pretty decent clip, and at the same time they're growing profitably. So it's not like this company's not generating profits. They're generating significant operating profits. So we can actually just show that real quick too. Operating profits are right here. So you're not investing in like a startup or a brand new concept. This company generates roughly $6 billion in operating profits. Now, this is where things get interesting. In 2022, oh, and by the way, let's kind of talk about what they do before we get into like the numbers. Fiserv, one, has all these relationships with banks, but they also have this second division that works with clients. So if you ever go to like the store and you go and you give them your credit card, all the processing and everything else, it's all done by a company like Fiserv. So there's three major players out there that have POS systems, point of sale systems. One is Fiserv through their company called Clover. Another one is Toast, which everyone has probably heard of now because it's in the restaurant space, and the other one is Square, which is owned by Block. So that transaction generates a fee, and Fiserv collects that fee, right? So the more point of sale systems that are out there in the world, the more fees these guys collect for making sure that transaction goes correctly. The other thing is, because they provide the technology for a lot of banks, they have relationships with the banks where the banks pay them fees for that. So that's where I'll stop right there. So the business itself is not that complicated to understand. The key is that they are a single to low double-digit growth business. Now, when you have a business like this, people like it because it's consistent, right? You've got this nice, consistent upward trajectory since that merger. And so a lot of people are like, wow, this is great. And shareholders have taken notice that, wow, these guys are durable, they're predictable in terms of their growth. And because of that, their stock price has actually done really, really well, or at least did really, really well all up until December of 2024. So you can see here in 2015, the stock price was 45. It got together. This is where the merger happened. It got back to about 125. It came down post-COVID during the great recession that never was. And then it started to kind of accelerate upwards. Now, one of the reasons why it got this giant boost upwards is because they committed a lot of money towards share purchases. And because of those share purchases, they were able to grow their EPS significantly. So if you look at their earnings per let's look at their repurchase program, and we will put up right here. So you see this in the red. That is all that is the total dollar value of all the shares that they were purchasing. So prior to First Data merger, they're buying back about 1.5 billion in shares, right? And then after that, they kind of upgraded to about 2.5, 2.3, and then right here in 2023, their buybacks just absolutely exploded. So eventually, they got to about $7 billion a year of share buyback. So last year they bought $7 billion of their own stock back. So when people look at this, they're like, wow, this must mean that their bottom line is getting supercharged by share repurchases. And on face value, that's exactly what's happening. So if you look at the EPS, per share EPS right here, diluted EPS, their diluted EPS absolutely exploded. Just hide this, hide this, hide this. So in 2021, they went from $1.18 a share to now $6.05 on a GAAP basis, on a TTM GAAP basis, $6.05 per share. Look at that growth in EPS. So when you buy back your shares and you buy them back significantly, one of the things that you're going to get is a lot of EPS growth, which for shareholders is really good, right? So as long as they can keep growing this EPS number, everything is good. Everything is running nicely. The stock price will move along with it because people are like, wow, this is a value play. This is where we want to be. And I'll just kind of take away this last few months just to show people. So everything is running great, right? Fiserv's doing good. Fiserv is, buying back a whole bunch of shares. They're growing their operating margins. Perfect business. Then the shit hits the fan. And this is where you have to kind of deep dive into what exactly happened to this company. Well, it turns out that they had some one-time events that came along that made them super, super profitable. And that actually came from a very niche incident. Well, not necessarily incident, but a trend where they process a lot of the transactions in Argentina. And one of the businesses that they have in Argentina is that if you have this high level of inflation and you're going to get paid 30 days from now, if let's say you go into a shop in Argentina and you say, okay, this is, $100, 100 pesos worth of goods, and you swipe your card, it's not like the merchant gets it in his bank account within the 2 seconds. It usually is 30 days later, right? So if you're a merchant and you get paid 30 days later, the problem is if you have inflation running at close to Yeah, if you have inflation running at almost 300% per year, by the time you actually get paid, it's not the same amount, right? So the question to you is, Stephen, hey, do you want to wait 30 days to get paid when inflation is like this? No, right? You want your money right away because that
Me,
means that because you want to use that money and change it to dollars, right? In Argentina, by the way, they have like this black market economy with US dollars.
the
You
problem
want
is
to
when
convert
inflation is
it.
going up, you don't want your money sitting idle where you can't touch it because it gets devalued. That's the bottom line.
Exactly. Exactly. So one of the services that Fiserv offered was, hey, if you want immediate pay, right? If you want your payment right away, we will do that for you, but we're going to charge you a fee, right? And they were able to charge that fee at the right time. And basically, it boosted their earnings significantly. So that those fees that they were charging a lot of these Argentinian businesses, that came into into their earnings, well, their top line revenue growth and their earnings. So right here, I can show you guys this. So if you look in 2022, in Argentina, their revenue was just 330 million, $337 million. All right. So fairly, they were doing just transactions, normal, fine. Inflation was still high, but it wasn't like crazy high. 2023, that jumped to $546 in revenue. And then that impact from the currency ended up being almost $650 million. This is in dollars, not pesos. So look at that. Look at that growth right there. So they were generating 300 million from Argentina. That jumped to 1.2 billion. Wow. That's great, crazy growth, right? And if you look at it at the year end of 2024, that number jumped all the way to $2.3 billion. So it's like, holy shit, these guys are making a crap ton of money and they're generating almost $2.3 billion just from Argentina. And the margin on that money that was coming in from Argentina was twice the margin that they were making on their other business, their regular business. Now, the challenge is now that inflation in Argentina is going down, what happens? Well, you're not going to get this crazy high revenue anymore, right? This crazy high growth anymore. You're going to actually have it go down to something like this. So inflation has come down significantly in Argentina. So you can see here. So the fees that they were collecting are not going to be there anymore, right? And so you're thinking to yourself, well, you know what? That means that their revenue growth rate will go from, let's say, 10% to 6%. Who gives a shit? You know, like it's still a good business, generates cash flows. Well, the problem that you run into is that if your growth expectations by your last CEO are based on this giant growth, they actually guided to about $10 in earnings. What do you think happens to the new CEO when they do not have that tailwind behind it anymore? Imagine coming out and saying to someone, hey, listen, last couple of years we made this really crazy gain and return from Argentina that's no longer there anymore, and our earnings are actually going to start going down. Everyone gets confused and the market just absolutely sells this thing off. Now, you would think that, listen, the currency impact, that's bad, but it's not like, oh my God, a kill shot, right? Like it's not that big of a deal. It's like, all right, they're not going to make an additional $1 billion in EBITDA every year anymore from Argentina. Whatever. They still have a strong business. They're still buying back shares. And that's where you have to dig in a little bit further. And this is where you're going to see shareholder value destruction 101 from a CEO slash CFO perspective. Now, remember I said that they were buying back shares and they were buying back about $7 billion in shares. If they were using nothing but cash from operating activities and they didn't have any capex, then yeah, it would make a lot of sense. They're like, look, let me just hide this thing. Sorry. So right now, this company per year, if it only generated $6 billion and it didn't spend any money on CapEx, then the $7 billion is affordable. Right? It's like, okay, yeah, whatever. It's like maybe they have some cash on the side sitting that they can use to buy back shares. Well, the problem is this operating cash they have, number one, they spend about capex. They spend about 1.5 to 1.7 billion dollars a year on capital expenses. So if you, first of all, if you're generating operating income of 6 billion and you take away 1.7 billion in capex, that means you're left with 4.3 billion, right? To basically do things with. Well, how do you get the money to do that, to keep up with that buyback? And this is where the problems start. If you look at the net issuance of debt, look at this. They started to issue, let me do it on TTM basis because that's probably easier to see. They started to issue a lot of debt alongside of those share buybacks. So they took cash flows that they were getting already and they were buying back shares. Now, the problem is if you are buying back your shares at a decent price, it's one thing. But they were paying, they were buying back their shares at, what the hell? Stock price. Okay, there you go. They were buying back shares right here when things were super expensive. And the entire time they were financing it with debt. Okay? Look at this giant move up in stock price. So if your stock is trading here at 120, 110, and you're buying back shares, that sort of makes sense. But then when your stock is just riding higher and higher and higher, right? At some point, the yield on those buybacks is not going to be that great. And that's exactly what happened, where this company, because of its super growth, got a very, very healthy multiple, and the stock went absolutely berserk onto the upside, and the company was buying back shares. But they were financing it with a combination of cash from operations and debt. Now they've got to the point where they have almost $28 billion in debt, and that one-time impact from Argentina is gone. So now you're loaded up the balance sheet with debt, and at the same time, you can't do buybacks because now you're leveraged. Now you're earning money that's over 3x your net debt to EBITDA. So this is where problems start, because now the new management comes in. So the old management was this guy, Frank the Tank, or Frank Basignano. That was his name. He is actually in charge of the Social Security Administration now under the Trump administration. And because he took a government position, he was able to sell all of his stock tax-free. So he got out pretty much at the right time. And now you've got the shareholders at Fiserv left with, one, declining revenues, because there's no longer the impact of Argentina boosting your revenue. So your revenue growth rate went from 10% now down to 3%. And if it's not even 3%, it might actually be negative next year. And at the same time, you've loaded the company up with a lot of debt, and the charges on that debt, the cost of interest on the debt now is roughly your interest charges used to be 700 million. Now your charges are about per year about 1.2 billion. So you basically stole, I want to say you stole, but you basically destroyed shareholder value long term to boost up the share price short term, and then you got out. And that's what happened. And I'll stop right there, and I think it's good to ask some questions. So I think you're muted.
I'm muted, so you didn't hear me typing. So I was just building something out, and I have a bunch of questions. So good job explaining everything. So I get it. Argentina made everything decline. So here is what I built. I guess I got to remove yours first. It should just be one click. I shouldn't have to remove yours first. So nothing fancy like the fancy program you're using, just some old fashioned Steve spreadsheets. So not really growing. Profitability is going down. So year over year, revenue's up just under 1%, but gross profits down just over 3% in Q3, while operating income is down over 15%. Cash from operations is down almost 20%. Net income increased by 40%, but that's a metric that I take with a grain of salt because there could be tax benefits added in there. So I care more about operating cash and operating income at the moment going down. Now, what's in the pipeline to reverse this? Because they're also seeing their margins compress. Gross profit margin, operating income margin, and cash from operations margin, all three of those compressed year over year.
Right, but that's because of Argentina.
Argentina,
right? Remember,
right.
right. So as Argentina, that business boost rolls off, of course, you're going to see margin declines, right?
Yep.
But the key to remember is you have to look at this company pre-Argentina and say, what were the margins before Argentina?
When did Argentina become part of the revenue? Do we know?
2022 is when they started to hit higher. The end of 2022 is when inflation really picked up in Argentina. So I would say any numbers prior to December 2022 is a good benchmark for what the margins on this company long term are going to look like.
All right, so we're going to do it on a TTM basis then, same thing.
Yeah.
So give me 1 sec and I'll just copy everything in.
I think you're doing year over year, right? Yeah.
Yeah, I'm gonna do the year over year.
It's more, by the way, it's more accurate to look at 2021 to 2022. Actually, 2020 to 2022, because that's when the merger actually happened. Okay. So even if you use the numbers from, like, let's say 2015, 16, it wouldn't necessarily work out very well.
I'm just grabbing everything because that's what I have access to.
Yeah.
I'll rip out 2020, 21, 2022.
Yeah.
All right. So
there's one other thing that these guys did that management had to reverse. It's a smaller impact than Argentina, but it's an impact still worth discussing. Their POS system, Clover, they prioritized raising prices and doing a lot of quote unquote fees in their thing. And so customers had a bit of a revolt, right? So one of the things that people have is once you get these POS systems, it's really difficult to switch out of it because you have to train everyone new, you have to get new technology implemented and all this other stuff. So a lot of times businesses, they have a POS system, they're going to keep it. Well, the last management team basically said we can keep raising prices on the transactions and basically boost up our earnings, right? Because these guys ain't going nowhere. They ain't switching. Well, guess what? If you charge your customers enough, they're going to goddamn switch. And so the current management is also trying to reduce down that what is that thing called? That those price increases, those price hikes. So that will impact their margins also.
So this is without Argentina, 2020 to 2022. Are we saying here that over the next 2 years, it should look somewhat similar to this on a growth perspective?
So I stripped out all the numbers, and if you want, you can just use these as raw numbers. So 2026, if you want to plug it in, let me just double check everything that I have. This
All right,
is
so
the
I'm gonna make a new one with where we are on the TTM. What do you think 2026 is going to be?
outside of Argentina impact. Let me just double check 1 second. The revenue growth. They haven't given a 2026 guidance yet, but just some quick math. If they do about 3% on top of 25, so let's say 19 times 0.3, so it's like 19 times 0.0. Hold on. 19 times 1.0. 19.57. I'm being conservative, by the way, everyone. Okay.
So
Now the gross profit margin is probably going to be, and I'll tell you 1 second.
you're actually very conservative from what 29 analysts are saying.
Yes.
They have it coming in at 20.4.
Yeah, I'm being conservative because
Okay.
that's just how you when I invest, you want to give yourself a lot of margin of safety. So that's what
So
I'm trying
off
to
of the
do.
TTM, it's going to be down year over year.
Yes.
Okay.
So their gross margins with the impact from Argentina is roughly 60%. I don't think they're going to be 60%. I think they're probably going to be closer to 50% roughly. So I would say probably 50%,
All
right? So
one
gross
second.
profit. Yeah.
Okay.
Now, operating income, you can subtract about 1 point from interest. You can subtract about, let me see, because the interest, they're not really going to have much that they can do with. So you can subtract about 1.4 billion from that.
Okay. So what's going to get the market excited? The numbers are interesting. Big cash flowing business. What's going to get the market excited about this? Because they're still putting up good numbers, and with their EBITDA and cash from operations, free cash flow, I'm not really worried about the debt pile too much.
Okay, so this is the just basic gist of what I think is going to happen. You're looking at about 8 billion in EBITDA, right? They have 28 billion in net debt. So if you have 28 billion net debt, you're about roughly three and a half times levered, which is not great, but it's not bad either.
Yeah,
right? It's not like, oh my God.
Though.
So the thing is they're targeting getting back under 3% leverage, right? They only have about $3 billion coming due in the next 2 years. So they're not like, oh my God, we need to definitely de-lever. But if you look at their EV, enterprise value to EBITDA, it's gone down significantly. So the first thing you're going to see is them paying down about 1.5 billion from their cash flows, right? So per year, they're going to generate about 6 billion in operating cash, right? The operating cash is probably going to go down to like 5. So from 5, they pay about 1.5 towards CapEx, right? And then the rest is going to be there for dividend repayments and for share buybacks. So the 1.5, so it's basically about 5.5 minus 1.5 for CapEx, right? That leaves 4, and then you subtract another 1.5 for debt repayment, and then you're left with about 2.5 billion in free cash flow. So that 2.5 billion, it doesn't sound like much, but with the share price that's been beaten down so much, that's a pretty good amount of share buybacks that they can do, right? It's one thing if the share price was $120, $130, it wouldn't interest me. But at $60 right now, they could buy back a good chunk of their of shares outstanding. Because right now the market cap went from about 100 billion down to like 30 billion now. With $66 a share right now, I think it's 36 billion, right? So if you're thinking about it on a per year basis, you're able to buy back 2.5 billion shares. And then the year, not 2.5 billion shares, $2.5 billion worth of shares. And then the next year after that, you could probably do about 3. So you've got some organic growth that's going to come in, and some of that debt is going to go down. So their leverage ratio, because they're paying down their debt, is going to go down. Their EBITDA is going to go up because 2026 is that trough year where they no longer have Argentina to rely on, but they can actually grow the business at a pretty steady pace. So if they generate 500 billion more in EBITDA in 2027, then you've got yourself this nice like recovery, right? And then you just kind of go forward. And a lot of their capital return strategy is centered around share buybacks. So the part that people get confused is, with that much debt on the balance sheet, does that mean that they have to pay it all off? It's like, no, most businesses, they actually keep a healthy amount of debt on the balance sheet. The other thing is, a lot of the debt that they have issued is actually cheap debt that's under 4%. So there's no point in paying down the debt super early. The only debt that you want to pay down is the maturities that are coming up that you have to pay. So $3 billion is going to go to debt repayments, which will bring their debt down to about 25 billion. Their EBITDA is going to be about 8.4 billion in 27, right? So that puts them at a very comfortable place in terms of what is that thing called? In terms of leverage ratios. Now, here's the thing. I'm being conservative. The current market is guiding for 8.5 billion in EBITDA next year, and then 9 billion the year after. Is that what the market is saying on your end? Like, what do you see as the analyst projections?
So I'll bring it up and share the screen. And I'm actually surprised because there's a lot of analysts that cover this company. There's more analysts than I thought covering. So, not a whole lot of growth from the analyst community. They think in 27 it'll be a good year, or the next 2 years are basically transition years on EPS.
Correct.
And then low single digit for revenue growth.
Yep. But look at that EPS growth all the way to 2030. Because of the massive amounts of share buybacks. So on a forward PE basis, this company, because it is a tech company with tech-like multiples, even though the growth rate isn't that great, because that cash flow is going into paying down, buying back those shares, look at the EPS that they're going to get in 2027, close to $9.58. Let's say you said, screw it, I'm going to take you're going to shave off $15 from that. 15% from that. You would still be left with close to $8.70, $8.90 in EPS. If you were to put, let's say, a 15 multiple on it, this company, if you look at on a PE basis, on a forward PE basis, this has usually traded upwards of 20 PE. If you had just go to 15 PE, that is a pretty good return. And look at the growth rate on that EPS.
So I don't like that post 2027, there's only 2 analysts in 28, 2 analysts in 29, 1 analyst in 2020. 2027 I'll take seriously because there's 24 analysts. Trading at 6.5 times 2027 earnings is very interesting, especially if they're able to start getting some more growth in market share and revenue. The real question is, who are their big competitors and what other verticals can they move into? Because if this is a company that can either make some small acquisitions or grow their verticals, paying 6.5 times forward is very interesting.
Now, here's the part that a lot of people probably are not looking at. They have businesses that they have acquired in their business that have a higher EV to EBITDA right now. So they could theoretically sell that business that's non-core to their operations, get that cash and use that to buy back shares. And now all of a sudden you're going, or pay down the debt and buy some of the shares. And now all of a sudden your EPS is even higher. Right. So if you think about it, let's say you have you're trading at a 6 EV to to EBITDA right now, and you have a business underlying in your stack that is, quote unquote, someone is willing to pay 15 EV to EBITDA, that's a super value generator for you right now with the share price to where it is. The question here is going to be around what is their growth rate going to look like next year and the year after that. So
yeah, I mean that's always the question. I mean, it's interesting. You made me interested to the point where I'm going to start doing some more research. Now, how does Block compete with them? Is Block still has their point of sale system?
mm-hmm.
And then I would guess Shift 4 is another competitor, correct?
Correct. Yep.
A little bit of a crowd space.
but-
What's the
but-
differentiator with them? Do they?
but Steve, it's not. You're talking about global payments around the world. Do you know how big that market is?
Oh,
And and we're moving away from cash. Like every society on the planet is moving to cashless, right? So the thing is, this market is still a growing market. So all you have to do is just make sure that you're still keeping up with it. So it's not like, oh my God, you're investing in a very mature industry. That's why Toast, that's why Shift Forward, all of these guys are around, right? Because there are still more and more businesses that are going cashless, especially outside of the US. We may be a lot more cashless here in the US, but around the world, there's still a lot of countries where things are done primarily, transactions are done primarily in cash. And Fiserv is all over the entire planet. They also have a lot of relationships with banks because of the banking relationships that they have. So a lot of them end up pushing their POS system through that channel as well. They have a whole bunch of independent retailers that do the point of sale sales for Fiserv. So this business model has worked really, really well over the last, 10, 15 years. But now there is a re-rating happening in this company. Now, do I think this company is going to 5x and 10x? Like, no, this is not a software business that's doing, 20%, 30%, 50% growth per year. But there's a lot of value in this company from the cash flows it generates, and those cash flows end up going to share buybacks and generates value for shareholders that way. Right now, this is not a company that is going to benefit from a lot of technology changes. Now, there is supposedly some efficiencies that could gain from AI, right? That's another thing that we can talk about. Right now, they have a good number of employees. They could probably cut down on some employees, save some cash that way, use that cash to pay down debt and buy back shares. And there is some drive for efficiency that's probably gonna be there. But the key here is this company has dropped off so much that now there is a good chance of this recovering back to the mean again once this 2026 year finally ends and the numbers are not nearly as bad as what I'm trying to say, or even what the market is saying. So it's almost like the expectations have been dialed back too far. And this is where a lot of value investors are probably going to get in and bid up the shares once they wake up to the fundamentals. So if you look at something like UNH, I agree that UNH definitely should have been kicked a little bit to come down from like 550s. But do I think it deserved to be $200? No, of course not. They generate significant amount of cash flows and margins and everything else. And while they have some short-term weaknesses, long-term, they're still a very strong business with great operating cash. So that's the key here for this business.
Look, it's very interesting because of the amount of cash they're throwing off.
Yeah.
It's very interesting. Well, I am definitely going to start looking into it. Have you started a position yet?
Yeah. By the way, Fiserv, you ever transferred money through Zelle? Do you know who owns Zelle? Fiserv.
Well, you could have led with that.
Yeah. Well,
you could have led with that. That would have got me a little bit more interested.
Yeah.
All right. Now you've really piqued my interest getting this at 6.5 times is definitely interesting.
Yeah, like Zelle, all the card issuances. These guys do a lot of stuff that people don't necessarily give them a lot of credit for. So, and like I said, they're a very strong, durable business with a ton of relationships all over this industry. So, I mean, you wouldn't know it if you didn't work in the banking sector. So, the other couple of catalysts that they have coming up, believe it or not, is they're moving over their listing from S&P to like NASDAQ, because they're like, we're a tech company. So you might see some inflows from that. So, yeah.
All right. Well, listen, I'm interested. I will do some due diligence. Who knows? Maybe there's an article that comes out of this. We'll see. But
Yeah.
I'm pretty freaking interested.
Yeah. This is your traditional, like, deep value play. You know, this is not as simple as, I don't think Fiserv owns Zelle. Let me see. Hold on.
So I have two questions for you, not related to Fiserv. So whenever you want to transition, I will ask you.
It's owned by Early Warning Systems, a company co-owned by 7 largest banks. That is correct. Fiserv works with financial institutions to enable and provide Zelle for customer service. Zelle's ownership is by Bank of America, Capital One, JP Morgan. Fiserv's role is a financial technology company that provides solutions to banks, allowing them to integrate services like Zelle into their own platform.
So they own
handle
the
the
architecture to
implementation.
integrate.
Yes, exactly.
Gotcha.
So they underlying technology that enables it. So yes, Zelle is owned by the big banks. The technology under it works on Fiserv.
Gotcha. Okay. All right. I'm going to do a bunch of research.
Yeah.
All right. I have a Costco question for you.
Okay.
And listen, everybody, what I'm about to say, do not go do. Okay. I am wondering if this is now a hack that I just thought of. And I don't know if this would work, and I don't know what Costco is selling at, but you know the gold bars Costco is selling? Are they sold at spot? Do you know, or how much over spot are they sold at? The Pamp Swiss bars.
I'm sorry, say that again?
The 1 ounce gold bars that Costco sells. Do you know how much over spot they are sold at? Or
No.
if they're sold at spot?
I don't know. No clue.
So 5 hours ago, I'm going to pull this up. Because I just found, of course, I'm scrolling on X and just found it to answer my own question. Now, I'm not sure if this is true.
Yeah.
But I got a money hack right now.
Sorry, take a look at this. This is what I was looking at. Sorry. Approximately 151 million enrolled Zelle users, right? And over $1 trillion in payments processed in 2024 and 3.6 billion transactions processed in 2024. So this is like the what is it called? The size of their transactions, their volumes, which is like more than pretty much a lot of other ones. So if you want to do a comparison when you're doing your research on total transaction volumes on, let's say, PayPal and Block and everything else, this is what you benchmark against.
Gotcha. Okay.
Yeah.
Well, this account Silver Trade, basically either I stole their idea without knowing about it, or they just came up with it quicker than me. And I like theirs better because I was using 3%. They're using 4%. Check out this freaking hack.
Okay.
So they took a screenshot. This is from 5 hours ago, but look, I don't know when their picture is from, but they made this post 5 hours ago that the Pamp Swiss bar is selling for $4,089. Now, I'm on SD Bullion. That's under spot. Spot is 41.47 right now. So you're already getting it under spot. And I was thinking, okay, if you use the Robinhood credit card, you get 3% back. I didn't know that there's a Costco card that gives you 4% back. Think about those numbers. You can theoretically go buy it, get the cash rewards on your credit card if you have a 3 or 4% card, and just go to any pawn shop and just sell it on the spot. At spot. Bless you.
Yeah, here's the thing. I don't know if Costco will allow it though. Would they?
Why
to buy a
not?
rewards card for Gold Bar?
I mean, and think about this. And I did the research before. 45 states have tax exemptions on bullion, bars, and coins for investment purposes over $1,000. So you don't even pay sales tax.
Well, I mean,
that's no more than an argument.
Does the Costco sales associate with that?
No,
they charge sales tax for it?
I'm sure it's in the system that this is for an investment purpose and it's over $1,000, so you wouldn't pay sales tax on it. So think about it, no sales tax. If this is true where Costco's selling it under spot and you have a credit card that gives you a couple of points back, that's actually a real money hack.
I don't know. It seems like a lot of moving around for a few percentage points. I mean, how to make this profitable limit of 5, so that means you have to do at least like $20,000, right? $20,000. Like, what was the profit on it? And then the pawn shop is they're not gonna give you spot. They're gonna take their cut.
A lot of shops pay spot.
Really?
Yeah.
I'm shocked by that.
Oh yeah, a lot of places pay spot.
So then why wouldn't the pawn shop guys just go to Costco and buy?
I don't think anybody realizes this. Like, I used to invest in this stuff and I didn't even realize that Costco was selling this for under spot. Somebody freaking said it to me in the chat the other day, and I just got around to looking at it today. And I'm like, holy cow. And I found a different post. It wasn't this one. And then I started thinking, okay, credit card points back, et cetera, et cetera. Pretty freaking interesting.
I did not take a look at Fidelity Information Systems other than just to compare what the multiple that Fidelity is getting versus Fiserv. So my thing is I've been trying to do comparisons. So thank you for that $5.
Oh, thank you very much. And Dookie Pie, thank you very much. Yeah, so I don't know. Let me know what you think. Yeah, so we have people saying Costco updates the price daily. So let me know what you guys think about this. I mean, it's an interesting idea. I may actually go to Costco.
Just checked my receipt, bought 0 in February. New York, 0 sales tax.
Yeah, no, seriously. 0 sales tax over $1,000 in 45 states on bars and bullion that are investment grade. It can't be jewelry. It's not applicable to jewelry. Like, I actually did all the research on this. Because I already thought sales tax wipes out the margin, but I think as long as you have a place that's willing to pay spot or even a couple of bucks under spot at this point, you make $1,000 in a day from a combination of cash on top of whatever the prices you pay, plus getting the reward points back on your credit card bill.
It's pretty good if you think about it.
Actually, an interesting arbitrage idea.
I mean, you got to get a pawn shop to give you a spot. That's my only thing. If you can find us a pawn shop that gives you spot, it might be worth it.
Yeah, this is actually going to be a project for me, everybody. Yeah. This is going to be a project for me. I'm going to go to a couple of jewelry places and shops near the office and double check. And then if they're paying spot, I'm going to let you guys know if this actually works or not. I'll get back to everybody. I'll do the freaking boots on the ground research on this. I will let everybody know. This is freaking interesting. This is actually really freaking interesting, Chris.
I mean, try it. See what you.
Oh,
see
I'm
what
going
happens.
to.
Do test case and see if you can actually make money on it. Because if you do, then let me know. Because I'll go to my Costco right now.
Dude, I am 100% going.
Okay.
Oh my God. The freaking crazy ways to make money out there is wild.
Yeah. It is pretty interesting. Like, my father-in-law called me and he was asking, like, should I buy this gold in Costco? I was like, I guess you want to.
I mean, if that was like a year ago, it's doubled. I mean, gold was like 2,300, 2,400 an ounce last year, I think.
Yeah.
All right, so that was my first question. That was more of a, and you know what, Silver Trade, whoever you are, you just got to follow out of me for posting that.
Well, the challenge is now everyone's retweeting it on Twitter.
Yeah, let's not retweet this, please. And not
It's got 200. It's already got 250,000 views.
Do not screw this up for Steve.
It's not arbitrage because you can't sell it at spot easily. That's pretty much what every comment is saying.
I'm telling you that I am going to go do the boots on the ground research. There's a lot of places I think that buy at spot. I see the signs all over the place when I drive through the city. We buy at spot. I see the signs.
Okay, well, what's the gold price right now?
Gold is at 41.50.68.
Let's see. And it moves how much daily right now? Almost moves like...
Dude, for the gold market's crazy right now. Like, you got to be able to go to Costco and then go straight. You can't sit on this for a day. Like, you got to go straight there.
Yeah. Interesting. I wonder how Costco's doing it.
They probably had a bunch of analysts project, and they probably bought a shit ton of gold, and they're just selling it at spot or just under spot as the market goes up. They're probably making a ton of money on this because they're probably into it for $3,000 because the gold market has just gone up.
So you're saying they wholesale bought the gold?
Well, I'm not saying they wholesale bought it. I'm saying, well, I guess they may have wholesaled it, but they probably bought a ton last year, the year before when they started doing this, and the market's been favorable to them.
Interesting.
Yeah, guys, PAMP is not, I'm telling you, PAMP is not fake. PAMP is one of the top places you can buy gold from for bullion. So that I do know. I'm actually into this stuff, weirdly enough.
You could just buy BM&R and sell calls against them.
I could, but this is cash in hand. Cash in hand.
Yeah.
It's freaking wild. Now that I think about it, really wild.
Here's a bigger question to you.
Yeah.
What do you think about the whole thing with the Burry post about
all right, I want to get to that in a sec. I want to cover that in Duolingo. Are you familiar with the whole Duolingo thing?
No.
Okay, so we won't talk about it then. Look at a chart. Data driven, who does an incredible amount of research, is super bullish. He tried explaining it to me. I didn't think that this is something I was interested in. It's gotten so clobbered that I'm now starting to look at it. But him and a bunch of other people are really bullish on this.
You're bullish on Duolingo?
I'm not. Kris and Kris Data Driven, not Chris Patel, and a couple other people that I'm in a group chat with are very bullish on Duolingo.
I mean, I like the CEO, but I haven't looked into the numbers to make it interesting. I mean, my research has been pretty much focused on some of these value plays, like this Verizon. I don't know if you saw Verizon. They're doing a debt offering of about 10 billion. For their merger with their buyout of Frontier. I was doing the calculations on leverage ratios, like how much would that grow their leverage ratio? And then at the same time, I was like, wait a second, no, they're still going to get EBITDA from it, and they're going to have synergies about 500 billion in EBITDA. So I'm like, I don't think it's really going to add much to it, So,
Maddie, check your X.
Yeah.
Let's talk about Burry. I sent Matt a link in case he's free. We can have a whole Burry discussion.
I think that's the part that gets me right now is
you're gonna have to give me. I don't know how Amit does this with going 4 hours without you in the head. Gotta give me 1 sec.
Yeah. Amit talks about chopping it off his dick. That's what he does. He's like, man, I really hate streaming because I can't go pee because it's bad. I think he puts on like a CNBC clip and then goes. But yeah, everyone in the chat, what's up? It's just me and you. Kris, I'm already feeling overexposed to Verizon. What other good safe plays out there? Time to start building a hedge against all this circular financing. I don't know, man. I don't know. Why does everyone Burry's S so much? Damn, you guys are vicious in the chat. Okay, so Burry is saying something very simple. He's saying a lot of these hyperscalers, when they're doing their reporting, they're basically saying that the GPUs that they have, the depreciation cycle is 5 years. And Burry's saying like, no, it's actually like 2.5, maybe 3 years. So the way that it works is, let's say you buy a product. If right now you buy an Nvidia GPU and it costs $50,000 and you have a 5-year depreciation cycle, you can depreciate $10,000 every year, right? Because over the next 5 years is when the useful life of that specific item is. The challenge that you run into is that, let's say the depreciation is only 2 years, where the value of the actual asset is not 50,000. It's like, it's 50,000 up front. You pay for it, but the depreciation is. Sorry, go ahead. Yeah,
I have to interrupt you, and I have to show you something that I just found. Okay. You're gonna hate me because you're gonna freaking get your credit card out and you're gonna order one.
Okay.
As we all know that you're a Star Wars fan, or you're not.
I am a Star Wars fan.
All right. I'm going to feel bad if you actually go buy this right now, but I may not because it's freaking amazing.
Me. Okay, show me.
A 1 ounce gold bar Vader and a Stormtrooper.
This is on what?
SD bullion. So that's what it is, from the Royal Mint of England. Like, this is legit. Okay?
I mean, this is like
legit.
It's like a collector's item.
Legit.
I got taxes. I'll buy it once tax season is over.
And if you pay by check, it's only $100 over spot, which is awesome.
Yeah. By wire. By Bitcoin?
Yeah, you can buy through Bitcoin also.
That's interesting. Now I have to save money for taxes, so unfortunately, not gonna do it.
The stuff that they come out with, we'll transition to Burry in a sec. Like the amount of 1 ounce gold bars they have is freaking wild on this site. Some of these designs.
You want to know how much gold my mom has?
You don't say it.
I'll say it. She has 3 kilos of gold.
Nice. Love it.
3 kilo. Yeah.
This one's pretty. I always thought that this one's pretty cool. Centurion, and then they got another Star Wars, Kris. Look at this. The Rebels.
Interesting. I'll wait. Like I said, I'll wait.
All right. Let's get into Michael Burry. Oh, whoa. Ray, you must actually be into this if you know about AppMex. We can have a separate conversation about this. because I actually am into this shit. All right, so Burry. I think that he is out of his freaking mind trying to go down a road. Now, I didn't read all of his tweets. I still call it tweets. The only way that it makes sense that he did what he did is if he really thinks this is round tipping. That's it. Round tipping, same difference. That's the only way. I understand buying a shit ton of puts on Palantir at these levels because I think that that could be a high probability. Buying it on Nvidia heading into earnings, when we see how much CapEx these companies are deploying, how much CapEx they're expanding by, and what the backlog in cloud is, does not make sense to me. The Palantir one makes sense. The Nvidia doesn't.
Okay.
Nvidia is not expensive here. If Nvidia was trading at 50 or 60 times forward earnings, I'd say, yeah, okay, that's a halfway decent bet. Nvidia trading at 24, 25 times 2027 earnings, and we already had all the big companies reporting. We know what they're spending and what the backlog is. The math isn't mathing for a short here.
Mm-hmm.
But Palantir, the math is mathing. Absolutely. So that's where I like half of it. I don't like the other half.
So here's a question. What's the Nvidia growth rate that you're expecting next year?
Dude, Nvidia is supposed to do 72% over the next 2 years on EPS growth. It's either
EPS
79%.
No, I'm saying top line growth.
I'll bring it up. I mean, dude, I backed my way into the numbers before. It's freaking crazy. But I'll use actual earnings numbers. And there's a lot of analysts showing this. So that's the other thing that makes me a little questionable. And look, this guy called one of the things that was next to impossible to call and put a lot of money on it. So you can't say he's absolutely crazy, but they're expected to do almost 60% revenue growth this year. And keep in mind, they report in January. So when it says January 26th, this is actually the 2025 calendar year. They're just 1 month ahead. And then in 26, 38.5%. Then in 27, 23%. Like they're going to increase by $147 billion of revenue in the next 2 years.
Yeah, but
that's a ton of freaking growth.
No, I totally get that. But look at that slowdown in growth. What kind of multiple would you give a business that's growing at single digits?
Yeah, but keep in mind, that's only 5 analysts. I don't think that's, I mean, look, we don't know if that's going to be the case or not. But regardless, they have a 56% profit margin, and their margins are not compressing. And when you look at the EPS growth, look at the EPS growth. I mean, it's actually trading, and I don't think that this number is updated yet with anything that happened today. I think it's more like 24 times 2027 earnings. But this is a company that's trading, as of this morning, just over 22 times forward earnings. Even the earnings for this year, 41 times, that's not bubble territory.
So you're saying you're not worried about this whole round tripping thing?
No, not at all. Here's why. They're trying to make it, if this was, and I lived through this with MPW, okay? And the whole thing with the short reports and everything. The biggest factor to remember is just because they did the investment with OpenAI does not mean that the round tripping is real. This is a situation where Microsoft, Meta, Alphabet, and Amazon are buying a ridiculous amount of chips. We know for sure Nvidia is not giving them money in an investment that's just getting plowed back into them. And Nvidia is also getting equity from OpenAI for their investment. Now, how OpenAI uses that capital, Who cares? I think Barry is wrong on the Nvidia side of this, but I think he could be very right on the Palantir side. I really do. I mean, on the Palantir side, look, you know how I feel about that. I would not be surprised if it goes to 125. But I also think Nvidia is going to end the year over 200, and I think that they could be at 250 next year. I don't know. What do you think about it? And Matt, if you're listening, I don't know why you haven't joined. You know, you say that I don't love you anymore, but every time I send you a link, you never come on.
My mom's owned this gold forever. She got it when she got married, and over the years, whenever she had extra cash, she used to work on 42nd Street, the Diamond District.
Oh,
So,
nice.
so she and back then, gold was only $200, $300 an ounce. So when her paychecks would come in, she would buy gold. So,
Dougie makes a good point that we can't see what OpenAI and Anthropic are doing because they're private companies. And Dougie, I agree with you from that aspect. At the same time, we can see what these other companies are doing, and we know there's 700 billion of backlog in cloud services just from Amazon, Alphabet, and Microsoft. We know that from the earnings calls. It's likely to get bigger. We know Oracle is a buyer. We know Meta is a buyer. We know CoreWeave is a buyer. I mean, we know that there's more buyers. So I think NVIDIA is going to be fine for the next couple of years. I can't handicap it past 2027, 2028, because I do think CapEx build out is going to go into maintenance mode at some point. But shorting NVIDIA here is pretty crazy, my opinion. I mean, Palantir, look at Palantir. Look at where they're trading right now. I mean, that's not a hard thing to buy puts on. 250 times earnings, 180 times next year, and 128 times 2027. I mean, there's only one analyst that's willing to even put that forward valuation of under 100 out there. So I don't think it's crazy that this guy put a bunch of puts out there on Palantir. I don't feel good about the NVIDIA side of it. So that's just me.
I would say this. I'm not saying that NVIDIA can't do well. I think it's going to do extremely well. My concern is twofold. One is if there's any other models that are coming out right now that have performance benchmarks that are very similar to ChatGPT but don't require as much training, and they can be trained at a much lower cost, then you got a problem. And one of the things have you heard of Kimi K2 from China?
No.
By any chance? They have a model out right now. It can run on a Mac. It can do. Check it out. Let me show you 1 second.
Have you seen Amazon's data center with all the Trianium chips?
Yeah, I've seen that.
I mean, yes, there are companies that are building other chips to augment their stuff.
Well, it's not a chip. It's not a chip. It's another AI model. A lot of people are talking about it, that this could be like another DeepSeek moment. I doubt it, but it's something that I'm hearing on the fringes rather than directly. So let me just bring it up.
I don't even know if we can play this, Chris.
No, it's actually like just came out. Like, I don't know if people have been researching it, not. In terms of benchmarks, it's actually beating ChatGPT 5. And it was trained under like 5. It's a trillion parameter open source model. So it's not like you can't go and try it and everything else. Like, no, it's pretty.
All right, I'll take a look.
Do you want to watch the video real
quick?
No,
because I don't know if it's copyright or not.
Yeah, but the point is,
look.
But the point is, there are other AI companies out there doing really innovative things. And the thing is, if they can do similar things to what cost billions of dollars by ChatGPT, that means that in the future, this model training, like model training need is going to diminish significantly. And that's the problem. So just saying. The one thing I'll tell you guys is just stop trying to disparage China when it comes to AI.
Oh yeah.
I know a lot of you people really need to get it through your heads that, oh, they're China, they're always like imitators, blah blah blah. Like, look, when it comes to certain things, take your competition seriously. Okay, the Chinese, they have the backing of the government. They've got low energy costs, and they have some really, really smart people over there. Okay, so if you think that, oh, you know what, we have Sam Altman, they have, you know, some Asian guy coding away. Trust me, they got some AI researchers over there that these guys in the U.S. would love to get. Okay, so just don't become this. I don't know what are they called, like this. Don't sleep on competitors. I mean, the U.S. auto industry did that shit in the 1960s and 70s and then lost huge market share to the Japanese automakers. Okay? The one thing we cannot do is go in a place where we start diminishing and disparaging people because of ethnicity and all this other stuff just because we think like they don't know what they're doing. Trust me, they've got a lot of smart people over in China. So, you know. And they got a lot of willpower to do things. So if they create something that's super disruptive, America will never use Chinese models. Maybe. But you know what? It's not just China, it's the entire world, man.
Yeah, so and that's a scary thing. Look, you have to remember China has 2.3 billion people now, 2.2 billion people.
They don't have that many. It's 1.4 billion.
1.4, whatever it is.
Yeah.
India has over 2. Which one has over 2? India?
No, they both have. Hold on, let me see.
Or maybe it's a forward number they're supposed to have. They have over 1 billion people there. They have a lot of brain power there, and they're very incentivized to be.
China has 1.4. India has 1.45.
So we'll see what happens. I mean, you can't discount them. They're very good with technology. We know this, so we'll see.
Yeah, we already do, and the open source models can be forked and run in the US. Yeah, that's right. I'm glad that you brought it up, Rufus. It's not one of those. They're all open source. It's not even like they're trying to do closed source shit. The value of all of the stuff that China is doing right now, they're open sourcing these models. We're spending hundreds of billions, if not tens of billions of dollars on all this on this training, and then these guys are doing it and just releasing them for free, man.
Yeah, I mean, it's going to be interesting. I want to see how this plays out because I can't believe this guy is that bullish on this that he's shorting Nvidia through puts. I still can't believe it. All right, so I'm starting to do some research online. I found one place that pays 99% of market price on gold. I know I've seen signs that I am going to make it my mission this week to find places that freaking buy at spot. I know I've seen the signs driving into the office.
Lily is the play for 2026. No exposure to House of Cards. Maybe. I do think the GLP-1s are going to be a major. I think right now GLP-1s are having their own little AI moment. The amount of people that are going to be on GLP-1s probably in the next 2 years, it's going to skyrocket. So, yeah.
They could. They definitely could. Anything else you want to go over tonight?
No, I think that's it, man. I've been trying to just research a lot of I've been researching mostly what the implications are on this government shutdown ending for the health insurance companies. And I was actually talking to Sam about this, where companies that have exposure to ACA are going to be challenged, but then there's other companies that don't have coverage to ACA. They might actually do well, primarily because the way that the enrollment system works is it's a little bit weird in that, okay, ACA, Affordable
You
Care
see
Act.
Oscar today?
Say that again. Oscar
You see
took a
Oscar Health?
17% dip.
They
Yeah,
got
took a
killed.
17% dip. Yeah, but that's because, okay, so let me kind of just break this down for everyone. If you go get insurance right now, you get healthcare insurance. If you get healthcare insurance through the ACA marketplace, the ACA marketplace has a lot of provisions in there that are good and bad, depending on who you are. They are good in a sense that they give you a lot of comprehensive care, like preventative care. They can't ask if you're overweight, or they don't take that into consideration. There's a lot of things with pre-existing conditions that, if you have it, it doesn't change your premiums. So for someone who actually needs it, it makes it really good. The problem is, if there's a lot of sick people in the pool, that means the price of those ACA prices go absolutely berserk, right? Because remember, if you have a lot of sick people and not enough healthy people, that means that now the risk pool is really bad. You work in insurance, so you know what I mean, Stephen, right? If you have a whole bunch of bad drivers in this insurance pool, it is a guarantee that everyone, even if you're a good driver, you're going to pay a way
Everybody
more for
feels it
insurance,
because it's the aggregate number.
right? So ACA works in that regard, where there's a lot of things that could basically insurance companies could charge a higher amount. Like, let's say right now, should a person, who's a terrible driver get the same insurance rate as someone who's a good driver? No. That's logic. But the ACA, it says that some things are unfair. Like, let's say a person gets cancer. They, of course, the cost of care for them is 100 times more than someone who doesn't have cancer, right? But at the same time, the person who doesn't have cancer is paying part of his premium towards the guy who does have cancer. That's how insurance works, especially in the ACA. That's how it works. If you take away these subsidies, a lot less people can afford ACA, which means that only people that are going to be on ACA or whatever, it's probably going to be the sickest people. So that means your risk pool gets absolutely insane, which means that whoever is in the marketplace has to charge that amount of premium to make sure that they're adequately being compensated for that risk pool. So right now, what the Trump administration is saying is, we take away this enhanced subsidy. A lot of people, they look at those premiums and they say to themselves, hey, I'm not going to pay no $2,000 a month for insurance. Screw that. I'll risk it. So they don't join. So now the only people that are left over there are people who basically are not healthy. They need that insurance. They need coverage. So they keep in that pool. And so what ends up happening now is that the ACA marketplace becomes very distorted. And it's not, and the thing is, it's not that the ACA subsidy is going away, because that's where a lot of people are, like the Democrats are fear mongering. Oh my God, ACA subsidy going away, everything bad. Like, no, the ACA subsidy is still there. It's just the enhanced subsidy that the Biden administration pushed, that's going away. So that additional $35 billion that the Biden administration allocated towards, that's going away, right? So I think the ACA marketplace is going to have a tough time, and a lot of insurers are getting out of it. They're just saying, screw it, we don't want to be here. If you don't want to pay a whole lot of money for the ACA coverage, we're not going to cover you. So what's happening is, instead, a lot of these people, I'm 22 years old, I'm 25 years old, whatever, I'm in a good shape physically, I'm healthy. I don't need to go to the doctor every other month. I can be okay, but I do need health insurance, because just in case something bad does happen, I need coverage. A lot of those people are going to be shifting to like catastrophic only care. Okay. Now, what is catastrophic only? That is the most slimmed down version of insurance, where it covers nothing except if the shit hits the fan, then it'll cover things. But other than that, it's going to be basically, and those are going to benefit someone like United Health, which sells those. Elevance sell those. Oscar is only in the ACA. So Oscar got whacked 17% today United Healthcare was barely down. So just let y'all know, if you guys are looking at the insurance plans right now, you're like look at the news that just happened. Can you show this, Steve, real quick? Let me just pull up the Webull thing on. If you look at the health insurance companies today, all of them got hit, every single one. But look at what happened with, there you go. Oscar, ACA is all they have. They got hit 17%. United Healthcare went down by barely 1%. Okay. You look at the other ones, CVS barely went down by 2%. Elevance. So this is all based on exposure to Medicare, Medicaid. Well, not Medicare, sorry, Medicaid and ACA. So a lot of the people that basically joined the ACA, they're going to end up having to choose this year during open enrollment. Are we going to get an ACA plan, or are we going to go for, catastrophic coverage only? And the thing is, if you look at catastrophic care only, it's super high margin for United and all of these guys. So, if anyone wants to see, this is what a catastrophic coverage. Hold on. Man, my. Where is it? Right here. This is what a lot of people are going to have to switch into. And if in order to apply, you must be under 30. You've completed a hardship exemption, whatever. But examples of covered major things: heart attack, cancer, trauma, hospitalization, surgery. But it does not cover anything else. Here. So this was one of the challenges that the Obamacare was trying to get rid of, right? So if you look at this, look, $127 a month. Great. You have it's $100 a month with a $15,000 deductible. Congratulations. With 50-50 co-insurance. This is what some people are going to end up having to sign up for. They're going to say, well, I don't really use healthcare all that much, so I can afford $180 with a lifetime max. ACA, I don't even think has a lifetime max. Which one would you choose, Stephen?
Honestly, I have no idea.
Yeah. I don't know. I get my health insurance through employer, so I wouldn't be able to tell you.
Yeah,
but
never looked
insurance
into this stuff.
Yeah. But this is like, look at this. This is only if you're young and healthy, which you're probably never going to use anything for. 3 years short-term health insurance. I'm telling you, UNH will do well selling these stupid things. Sadly. Whereas the ACA provides way more comprehensive care. Sorry. That's like a copper plan. Yeah, that's right. There's like gold, silver, bronze, copper. And then this is probably like, what plan? It's probably like,
Copper?
what's the most worthless metal?
Nickel.
Nickel. It's like the nickel plan. It's not even copper. It's nickel plan. Tin. Because it covers nothing. It barely covers anything. It's literally only if you're about to die. It's like, oh, thank God I have insurance that I have to pay a giant deductible for, and at the same time have co-insurance, and there's a maximum limit. So all these people that are going to be like, oh my God, the Obamacare is terrible. I have to, all right, Obamacare is terrible, apparently. The thing is, this is the challenge that you run into. If you're young and healthy, you don't want to pay a lot of insurance because you're not thinking about insurance. You're like, man, I'm young, I'm healthy, I go to the gym, I don't need health insurance. Like, that's $2,000 a month. When you're 50 years old, you're on 5 different medications, and you're dealing with all sorts of health related issues. The last thing you're thinking about is, hey man, I could maybe go without insurance. And those people need it. So yeah, whatever. Sorry, I might end up going a little too political, but unfortunately, when it comes to healthcare, that's all we really. That's one of the things that we have to keep an eye on and track. But yeah, that's why Molina, Centene, Oscar, they all took double-digit hits today, whereas United was fine, because if you look at the patient pools that United has mostly employer and Medicare. So.
This is getting crazy. Freaking Microsoft and its plans to get AI involved in medicine with their in-brain computer. I'm telling you, there is a huge opportunity somewhere in either biotech or genomics because of AI. I just have no idea where to even start.
Wait, say that again. I'm sorry.
Next generation brain computer interface. Microsoft says that there are signs it has already been working toward that end thanks to the partnership with in-brain neuroelectronics. Is geared toward producing real-time precision neurology and next-generation brain-computer interface therapeutics.
I don't know, man. I haven't seen any of those things like in real-world action. So
yeah, I don't know. Microsoft is very interesting to me at these levels. I think they're going to do really well. All right, Kris, do you want to cover anything else? You want to call it? What do you want to do?
I think we can call it, man. There's really not much we can talk about at this point, unless you're researching anything new. Like, what are your thoughts for next year?
I mean, look, my big thing for next year is QXO, because I think you're going to get a rotation out of tech to some degree. Or if we don't get a rotation out of tech, I think money comes into the market, and the money coming into the market is not necessarily going to gravitate toward tech, or it would have already. So the high dividend plays and non-tech stuff. I think Realty Income is going to do well in a low rate environment. I think NNN REIT is going to do well in a low rate environment. I think Verizon's going to do well. And, those are things that are constant yields that people can, when you talk about dividends, and maybe I'll do something next week, I'll come up with some REITs, but I know the argument against Realty Income. It's a solid argument. The bottom line, though, is no company that I know of has these type of stats for the dividend. And keep in mind, they pay monthly. So most companies increase their dividend on an annual basis. They have increased it on a quarterly basis for the past 112 quarters. And they pay monthly, and the yield is around 5.5%. So if you're looking for dividend income, and you got to think a lot of these people were harvesting in money markets to generate yield. Come back into the market, they're not taking on risk. So I think Realty Income is something that people are really going to get interested in. And I think it's at a good valuation here.
Yeah. I don't know. The only one that I'm looking at from a dividend perspective is Verizon. And I laid out the case pretty well the other day.
Listen, I like Verizon.
Yeah. I mean, I heard rumors that they're going to do, at the end of this month, they're going to do about a good number of layoffs, but on the storefront end. And what's funny is I was actually looking at the number of stores that Verizon has. Bro, I don't know why they have so many stores. Every time I've gone to any of these stores, it's been bare bones empty.
Dude, walk through New York City and tell me how many freaking cell phone stores you pass.
So many. They're like
So
on
many.
every other corner.
It's crazy.
I don't understand the purpose of having such a large retail footprint. You know, like in the chat, how many times have you guys gone to a T-Mobile or a Verizon store in the last like 5 years?
The last 2 phones I've gotten, maybe
Mhm.
even 3, I didn't go to the store. I went on Verizon's website, picked up what I wanted. They sent it to me. And after
Yeah,
I set it up, I packaged my phone and sent it in.
that's what I did too.
After I wiped it.
T-Mobile has 4 stores in my city. That's why Microsoft stores closed down. Yeah, it's a I don't understand what the real purpose is of the stores at this point.
So it says that there are 72 Verizon stores located in New York City when I typed it into the browser.
72?
70, that's what the browser says. Now, I did not use Google, so we'll switch to Google and say.
Yeah.
This is a much different answer. 55 Verizon stores in New York City, with 22 being total by Verizon and the 36 being in the Bronx. But I guess I could go on their website and figure out. But regardless, it's a lot of freaking stores.
There's too many stores, man. These brick and mortar stores, they cost money. They got employees, and they don't add too much to the value of the customer experience, in my opinion. A lot of Verizon stores are not owned and operated by Verizon. They're just branded by Verizon. Yeah, I mean, I'm talking about like corporate owned stores. Those are the ones that are probably going to go. Yeah. And that's the other thing. It's not like you need a SIM anymore either. Everything has an eSIM.
Yeah, so maybe we'll look at stuff for 2026. And what I want to do, even though our stock draft is not up until June,
Yeah.
if we're not doing anything on New Year's, I would like to do another stock draft run side by side. But 2 things.
You mean you
One,
could do a buy and a sell? Could you sell things and buy things?
yeah, I'm good. I'm good with that. Like, I want to do a whole thing, and
Okay.
two challenges. One, you got to beat the market because they'll actually be on a year-to-date basis. We'll start December 31st, and you got to beat everybody else. And it can be anything in the S&P 500.
That would be good. That would be good.
None of this truncated bullshit. Anything in the S&P 500. I mean, I would say the Russell, but do we really want to have 2,000 stocks to pick from? I mean, I guess we could.
Yeah.
And we'll invite everybody, and we'll do it. We'll make it live, and we'll go from there.
All right, brother. Well, I'll talk to you later. I'm probably going to get some sleep tonight because it is Veterans Day. Thank you, everyone in the chat.
Yes, thank you for
Happy
serving,
Veterans Day.
Chris. Please go follow Chris on X. Can you link your? I'll do it.
Yeah.
So if you're not following Chris on X, please go follow him. And we're going to try to get him to freaking start a YouTube channel.
Dude, I just don't want to. Here's the challenge with me doing the YouTube channel. All right.
So here's his X account. Please go follow him.
I want to do a YouTube channel, but at the same time, it's like if I can't commit the time to it, I don't want to just create it and then not put effort into it. You know, so the thing is, it's just one more thing on my plate. I told you I'm already like contemplating quitting my job. I'll probably know more in the next what is it called? In the next like few months. Yeah. And then if anything, I'll work on it. But yeah, I just don't want to commit to something and then it becomes a part of my day to day. And right now I like being the guest star on all of y'all's podcasts. So
all right, so we'll do another episode next week. I'll try to figure out something to pitch you. I may do. I think I have something.
Okay.
I got something.
Okay. Sounds good, guys.
All right. Well, thank you everybody for coming. Truly appreciate it. Go follow Chris on X, and we will see you next week for another episode of Inside the Numbers.
Take care.
Later, everyone.